Hey guys, thanks for watching my last video. And that one I touched a little bit on mortgages and pre-approvals. On this one, I'm going to be going exactly what is a mortgage, how to get one, all the way down to Fannie Mae, Freddie Mac, and mortgage-backed securities. So, starting off, what is a mortgage? Simply, it's a loan from a financial institution that uses your new home as collateral for the loan. So what that means is if you stop making payments or you default on the loan, the bank is going to repossess the house and sell it to recoup the losses. With that being known, that's why it's so important to be well qualified, and that's why these lenders have such strict regulations when it comes to getting pre-approved. So that brings me into my next point, which is what you're going to need when you do want to get pre-approved. You're going to need identification, proof of income like pay stubs, your bank statements, 2 years of previous tax returns, and a list of assets and debts that they'll collect from you when they do a credit pull. Lenders will want to see you under 47 to 50% DTI. Any income under 50% that doesn't go towards other debts, such as credit cards, car payments, or student loans, will be used to determine how much you qualify for. So for example, let's say you make $4,000 a month and you have $1,000 in revolving debts. So that means 25% of your income is going towards your debts currently, so you have a 25% DTI. The bank is going to see this and they're going to say that you have 25% left over to go towards getting pre-approved. That means you have $1,000 per month to use on a mortgage. So they'll look at that in the reverse math. $1,000 times 12 months is $12,000, and $12,000 times 30 years is $360,000. Now, $360,000 isn't what you're going to get pre-approved for because you also have to pay interest on the loan. That's a whole nother equation in itself that I'm not going to get into. That was just a quick example so that way you can kind of get an idea of what you might be qualified for in the future. So moving on, what if you have a co-borrower or a co-signer, and what's the difference? The main difference between a co-signer and a co-borrower is that a co-signer is guaranteeing the loan, whereas a co-borrower is taking on the loan as well. What that essentially means is that a co-borrower is also responsible for paying off the debt, whereas a co-signer is only responsible if the primary borrower stops paying or can't pay. Another big difference between a co-borrower and a co-signer is that the co-borrower is also going to be on the title of the home, whereas a co-signer would not be. Co-signers are typically loved ones who have no financial interest in the home, such as a parent or a brother or a sister, whereas co-borrowers are going to be couples or business partners. So that covers the when, what, why, and how of a mortgage. Now I'm going to delve into the types of different mortgages and the requirements. There are many, many different types of mortgages, but I'm only going to be covering the major three that 99% of you watching this video are going to use. Now is a good time to mention, if you haven't seen my first video, now is a good time to stop this one and go watch that one, because I'm going to be skipping over a lot of information that I covered in the first one. So with that being said, the first type of loan I'm going to talk about is a conventional loan. So to qualify for a conventional loan, you're going to need a 620 credit score at a minimum, 3% down. So if you're buying a $200,000 house, you need $6,000 to put down on it. And you need to have a DTI of less than 50%. It's a very standard mortgage with no other stipulations or contingencies to it, which is why sellers like to see conventional mortgages over the other types I'm going to mention. So the next loan type is an FHA loan, which stands for Federal Housing Administration. This is a government-backed loan insured by the FHA. An FHA loan is less restrictive when it comes to credit scores. You can have a credit score as low as 500 and still get qualified, but there is a stipulation to that. If your credit score is between 500 and 579, you will need to at least bring 10% down and have a DTI of less than 43%. Now, if your credit score is 580 or more, you can bring as little as 3.5% down on the home and have a DTI as high as 52%. With getting an FHA loan, there are two more contingencies you need to know about. The first is that the home you're purchasing must be your primary residence. And the second thing is that there's going to be a second inspection at the time of appraisal. This health and safety inspection is going to be done by the appraiser while he's out there appraising the home. He's going to be looking for GFCI outlets within 6 feet of a water source, chipping paint, or cracks in the driveway that are greater than an inch, things like that. FHA inspections usually aren't that big of a deal, and most homes can pass with minimal issues. However, sellers, given the choice between an FHA offer and a conventional offer that have all the other same contingencies, will choose the conventional because they know they're a more qualified buyer and they don't have the FHA inspection. So if you are going the FHA route, I'll be more than happy to talk about how we can write our offers so that they're more competitive and we can get you into the home that you love. The last type of loan I want to talk about is a VA loan, which stands for Veteran Affairs. Now, VA loans are a bit tricky because there are no requirements. What I mean by that is you can put zero down. There is no set requirement for credit score or DTI. With that being said, the lender is still going to look at all these things and determine how much you can qualify for. Let's say you're good in all other aspects, but you have a 60% DTI. The lender may still be able to work with you. With VA loans, you'll have a health and safety inspection just like the FHA, but there is another contingency, which is a pest inspection that will be done before or after the appraisal. So the next thing I want to touch on is PMI and MIP. They stand for Private Mortgage Insurance and Mortgage Insurance Premium. For a conventional loan, if you have a less than 20% loan to value ratio, so if you put down less than 20% of the home's value, then you will have to pay PMI, which will roughly be 0.5% to 1.5% of the loan's value. But over time, as you pay off the loan, once you hit that 20% loan to value ratio, your PMI will fall off and you'll no longer have to pay it. For an FHA loan, you'll have to pay MIP, which involves two payments. An upfront premium payment, which is 1.75% of your loan's value, and a second annually reoccurring payment. So for example, if you got a $150,000 loan, 1.75% would be $3,500, which would be due at closing. Alternatively, that upfront payment can be added onto your loan. However, your second annual payment is going to be determined by the size of your loan, how much you put down, and the length of your loan. For your annual payment, most lenders will just end up adding that to your monthly payment. So they take the total amount, divide it by 12, and you won't have to worry about a big payment every year. Moving on from PMI and MIP, the next thing I want to touch on is the length of loans. Mortgage loans come in all different lengths, but there are three most common, which again, 99% of you are going to use. So the 30-year fixed rate loan is the most popular because your payments are going to be lower compared to the other two, but you will have a higher interest rate. So the next one is a 15-year loan. This one is going to have a lower interest rate, but your monthly payments are going to be almost double because you're going to be paying it off twice as fast. So the last one is an adjustable rate mortgage, also known as an ARM. Now, ARMs come in all different shapes and sizes, but how they all generally work is that you're going to have a fixed rate for the first amount of years, and then after that, every 6 months or every year, your rate is going to change based on the market conditions. ARMs are great for when you think interest rates are high right now and they're going to drop in the future, because you're going to get a locked initial rate that's lower than a 30-year fixed or a 15-year fixed, and you can always refinance before it adjusts again. So real quick, I want to talk about what determines your interest rate. The biggest factor is going to be your credit score, but there's also your DTI, the type of loan you're using, your down payment, and the length of the loan. Now, if you're not happy with the interest rate that you have an option to buy down your rate with discount points. So discount points are just an optional fee you can pay to lower your interest rate. They're typically going to cost 1% of your mortgage, and it's going to lower your interest rate by 0.25%. So for example, if you had a $200,000 mortgage, if you wanted 2 points, that would cost you $4,000 and would decrease your interest rate by 0.5%. Again, this is a rough estimate. It's always going to depend on different factors. It's going to be around 1% of your mortgage and around 0.25% less interest rate. Now, the last thing I want to talk about doesn't necessarily tie into the real estate process, but it'll help you understand mortgage loans a lot more. I'm going to be talking about Fannie Mae and Freddie Mac. So both Fannie Mae and Freddie Mac are government agencies that were created to provide stability and liquidity to the mortgage market. Fannie Mae stands for Federal National Mortgage Association, and Freddie Mac stands for the Federal Home Loan Mortgage Corporation. How it essentially works is Fannie Mae and Freddie Mac will purchase loans from banks so that way the banks will get their liquidity back and create more mortgages. These two agencies will turn around and either keep the mortgages in their portfolio or sell them back as mortgage-backed securities, which secondary investors can buy and invest in. By allowing secondary investors to purchase these mortgage-backed securities, they lower interest rates, provide more stability, and more liquidity into the mortgage market. Fannie Mae and Freddie Mac have their own guidelines and restrictions when it comes to mortgages, which is where lenders get their guidelines, which is what I was talking about when it comes to credit score, DTI, down payment, those sorts of things. So the lenders have these requirements because if they have a borrower that fits all these requirements, they can then go ahead and sell the mortgage to Fannie Mae and Freddie Mac, therefore getting their liquidity back and originating another mortgage. So there are obviously a lot of details and intricacies when it comes to mortgages. I'm not able to cover everything, but if you do have any other questions, concerns, do not hesitate to reach out to me, call, text, email, anytime. You guys enjoy the rest of your day.